Hey, it's Matt Decker with Leveraged Wealth Management. I'm doing another product review on Index Universal Life Insurance. This one is going to be the North American Builder product. The Builder comes in a couple different varieties, but just to keep it generic, we're going over the North American Builder today. And just a couple things before we get started. I would love to see your comments below. I'd love to see you guys subscribe. But if you're going to leave a comment, make sure you watch the whole video because I'm going to try and cover as much of this as I can and make sure that we stick to the topic. Most of these product reviews are focused on maximum cash accumulation, minimum death benefit, and maximum income. So that's the purpose of this review, is to go through this Index Universal Life Insurance policy structured for maximum cash and income. So here we go. I always like to start with fees when we're talking about Index Universal Life Insurance policies. And the fees in this policy are average to good, meaning as long as it's structured the right way, the fees here are pretty much comparable to the rest of the industry, and a little bit more on fees in a little bit, but I would say that the fees are average to good. There's nothing really to be concerned about in terms of the fees that North American is charging, assuming that you have a policy that's structured the right way. And I'm going to show you an example of 4 policies, 2 of them done the right way, 2 done the wrong way at the end of this video. So make sure that you catch that at the end. In terms of the loan provisions on this particular contract, I actually like these loan provisions. So if you have seen many of my videos, you know that I break down loan provisions and we talk about the difference between wash loans, between participating loans, and then when it comes to participating loans, there are 3 types of participating loans. There are fixed participating loans, there are variable participating loans with a cap, and there are variable participating loans with no cap. This policy happens to have a variable participating loan capped at 6%. I like that. The reason I like that is because as an agent, as someone who offers these products, you can show a client, you can show somebody a variable loan rate at the cap, meaning it's not going to get any worse. So I like to be able to do that because it takes one of the variables off the table. Too often, people will use policies that have variable loan rates, but what they don't make known is that they're showing a variable loan rate that is, well below average. And so it makes all the numbers in the policy look better. With North American, you can avoid that completely just by illustrating their loans at the cap. So that's a good thing. I like that. In terms of the North American crediting, this is where, if there's a problem with the North American, it's in one of 2 places. This could be one of them. Most of their crediting methods are entirely S&P based. There's not much diversification in terms of how you can allocate your money inside of the North American product portfolio. So that is one knock on the North American product. It's almost entirely S&P based. They do, however, give you some pretty unique features. One's called like a systematic allocation option, where every single month they're going to move your money into one of the index options. What that's going to do is it's going to give you 12 different crediting days. So if you've done a lot of research on Index Universal Life, you know that sometimes your crediting date is an all or nothing type event. If your crediting date is January 22nd, well, January 22nd is going to determine your credit for the entire year. North American gives you the option to have 12 different days. So you have 12 different days that determine your credit at the end of the year. So what it's going to do is smooth out the ride. Less zeros, and you're not going to have as many years where you cap out because you have 12 different crediting buckets. Now, the cool thing about their crediting that is a huge bonus to this product, and this goes back to our conversation about fees, they are, to my knowledge at this point in time, the only carrier that credits your account before they take any fees out. So what that means is at the beginning of the year, let's say you have a $100,000 account balance and your fees for the year are $3,000, let's just say. Most carriers are going to credit you on $97,000 because 100 minus the $3,000 in fees, that's $97,000 left over. That's what determines your credit. North American actually does it the reverse. They say, well, hey, your beginning account value was $100,000, so we're going to give you your credit based on $100,000, and then we're going to take out the fees. So over the lifetime of a policy, 20, 30 years, that ends up being a lot of extra interest earned inside this product. So it's a really cool feature. They're one of the only carriers I know that does that to date. North American also has all 3 living benefit riders in, I believe, every state at this point. So that means that you get chronic illness, you get critical illness, and you get terminal illness, and you get that at no cost. So those 3 living benefit riders are a huge plus. There are only a couple companies that offer that. AIG Agla offers all 3 on some of their products. National Life LSW offers all 3 on their products. Transamerica has some products that offers all 3, and then I believe maybe Anico is another one that offers all 3. But in terms of the carriers out there that offer those living benefit riders, my opinion, North American is the best product that offers those 3 riders. So that is an added benefit to this North American Builder Index Universal Life. A new product feature that they've actually added to one of their newer iterations is called the return of premium option. Now, what this allows you to do is actually lower the amount of insurance that you're purchasing, which in turn is going to lower your fees. Okay, so this return of premium option, this is a death benefit option. If you've seen any of my other videos, you've heard me talk about level death benefit, increasing death benefit, or option 1 and option 2. This is option 3 or option C, return of premium, okay? So this is a relatively newer death benefit option. Most carriers do not offer this, and if they do offer it, it actually doesn't really help you. North American has kind of cracked the code on this. So they give you this return of premium death benefit option, and what it allows you to do is essentially accumulate more cash, number 1. The second thing it does is it kind of puts this policy on autopilot. With some of your other death benefit options, there comes a point in time down the road where you actually have to switch your death benefit option. And if you're working with somebody that doesn't really know what they're doing, which is unfortunately most of the people in this industry don't know what they're doing. If you're working with one of those people, they may not be able to help you make that switch at the right time. What that's going to do is hurt your policy values long term. With this option, it's kind of set it and forget it. You actually don't have to manage that death benefit option. You can keep it on option C for the life of the contract, which is really cool, and I like it, and it's a good thing long term. Now, the last thing that I'm going to say about this North American Builder IUL product before I show you 4 quick options is their underwriting is the biggest knock on North American. They are notoriously difficult from an underwriting standpoint. They are very, very strict in who they give out their top tiered rate classes for. So if you're super healthy, North American can be a great option for you. If you're thinking that, maybe you're not so healthy, North American is notoriously strict on their underwriting. So you need to know that going in. A lot of times they will look better on paper because they're not going to give you the rate class that maybe you're looking at. So if you have a North American policy and you want me to take a look at it and make sure that it's designed the right way, you can always do that at matt@leveragedwm.com, or you can go to leveragedwm.com/contact us, fill out the form, and I can get in contact with you that way as well. But I always tell people in any of these product reviews, the most important thing with any index universal life insurance policy is that it's designed the right way. Now, if you have a really good product, that can help mitigate a policy being designed the wrong way. And you'll see that with this North American product because it's a really good product. So even if the North American product is designed the wrong way, it can still look good on paper, but it could be so much better. So I'm going to show you 4 options of this North American Builder IUL product. It's going to be the exact same sample client. It's just a sample. There's going to be no difference between the 3 in terms of their age, their risk class, the premium that they're paying, when they're taking out money. All that's going to be the same. The only difference is I'm going to structure it the right way for maximum cash versus the wrong way, which is what I see all too often, where someone will pick a death benefit. In this case, it's going to be 1.5 million. So if you're working with a really bad advisor, they might say something to you like, you need $1.5 million worth of life insurance. So we're going to give you this North American policy for 1.5 million, and you can use it for income later on down the road. Okay, so that's a sales pitch, and that's going to result in you getting a policy that's not as efficient as possible. And let me show you what that's going to look like right now. Okay, so we've got 4 attachments here. I've named them Good Guy, and bad guy. So good guy is you're working with a good agent that knows what they're doing, that's trying to do the right thing. Bad guy is you're working with your typical bad life insurance agent that's just trying to sell you a product and generate a commission. And we're going to look at the difference between these four products based on the crediting rate and how it's structured. So we're starting with good guy, 6.64%. So this is showing the North American product at the default rate. The default rate is just the historical rate of return of this particular product. So it happens to be 6.64%. It's a relatively uncontested number. North America could show you the policies on the books and that they have performed at these rates, and so it's a relatively uncontested number. Don't get wrapped up in the 6.64. Just know that that's what we're showing. Okay, so this is a 40-year-old male, preferred non-tobacco, and we're paying $18,000 a year, and it happens to be split up monthly, so we're doing $1,500 a month. And you'll notice here that since this is that unique North American product, we're getting to use this death benefit option return of premium. Okay, that's going to give us a lower death benefit of $575,000, and you'll see the difference later when we compare it to bad guy. So $18,000 a year going in. It's going to go in until age 64, and then we're going to start a lifetime stream of income of $114,780 a year, tax-free for life. You can see that that just basically goes forever until age 100, and then we shut it off. And at 6.64%, if you live to age 95, let's say 94, 95 here, you've taken out $3.4 million in lifetime tax-free income, and you have $264,000 left over in death benefit. Again, that's at the 6.64% rate of return, okay? So this is structured the right way. Now, what I want to do is I want to show you a policy structured the right way, but using a lower rate of return. So let's say that you don't get 6.64%. Let's say that you get 5.5%, okay? So 110 basis points less than what we were showing before. Everything else is identical. We've got the same initial death benefit, $575. We're still using the return of premium, $1,500 a month, 40, male, preferred non-tobacco, $18,000 a year. And we take money out at the exact same time. So a fairly big difference, okay? We go from $114,000 all the way down to $74,000. So I would say that that's a big difference. Now, here's what's really cool about this. You can see here we've paid in $450,000, okay? So we're going to get our $450,000 out essentially 6 years into our income. Now, remember, at the 6.64% rate of return, we were looking at year 55, okay? So 450 went in, 3.4 comes out. Let's do the same thing at the lower rate of return. So 55 years, 94, 95, you put in $450,000, that's the same. You got out $2.1 million, okay? Much less. $2.1 million tax-free without market risk, and you're left with $179,000 in death benefit. Now, what's really cool about this is structured the right way, and it's assuming a bad rate of return. Almost every North American policy that I've seen, and certainly everyone that I've written, has averaged more than 5.5%, okay? So not to say that this is a worst case scenario, but this is certainly below average, no doubt about it. This is a below average policy performance if you're in it for the long haul. But what's really cool is $450,000, and you took out $2.1 million tax-free without any market risk. That's actually pretty phenomenal, okay? So these numbers by themselves, these are good. This is more of a stress tested policy, but it's designed the right way. Now I want to show you what happens if we design it the wrong way. Okay, so we're going to look at bad guy, 6.64%. And you'll notice everything is the same except this initial death benefit. So someone came to you and said, you need $1.5 million of life insurance. Oh, and we're going to do it in this policy that builds cash, and you can access it later on tax-free, and it's not subject to market risk and all that stuff, okay? That's how it's sold. So 1.5 million, and then it's an option 1 or level death benefit option. Those two things right there are really going to hurt our policy performance. So check this out. $18,000 a year. It's the same 6.64% rate of return as we showed over here on Good Guy, 6.64. The only difference is the death benefit and the death benefit option and the initial death benefit. Look what happens to our income. It goes from $114,000 all the way down to $88,000. Okay, that's a huge difference just in structuring the policy the wrong way. It has the exact same rate of return. It's just structured the wrong way, and it's costing you, $20,000 to $30,000 a year in retirement. So you live to age 95. Let's do the exact same exercise. You put in $450. That's the same. $2.6 million comes out. $308's left over in death benefit. So what's really interesting is if this policy is structured the right way, you can get over 1% lower rate of return, and you can almost come up with the exact same amount of money coming out as if you have a policy structured the wrong way, but you get an average to above average return. Okay. Now let's take it one step further and let's look at the same 5.5% doing this the wrong way. So 1.5 million, it's the level death benefit option. It's the same premium, 40-year-old male, preferred non-tobacco. Everything else is the same, but you were sold a policy that's not designed to perform. Okay. So at 5.5%, our income goes all the way down to $53,000. So this is what happens when a policy gets sold rather than bought. Okay. This policy was obviously sold, and it was probably sold in a vacuum, meaning it wasn't compared to anything else, because the truth of the matter is this is actually still sellable. You put in $450,000, and if you pass away at age 95, you got out $1.6 million tax-free without market risk and had $174,000 left over. So if you're coming up against a slick salesman who's really just looking out for themselves, they can make these numbers look good. They can tell this story so that it sounds appealing. The problem is you end up with this when you could have had something like this. And obviously, you'd much rather have the policy that's designed the right way, where a stress-tested policy done the right way is almost keeping pace with a policy that's kind of like average to above average done the wrong way. So that's what you want. This is the impact of doing it the right way versus doing it the wrong way. Doing it the right way, $114,000. Doing it the wrong way, $88,000. Everything else is the same. It's just working with somebody who knows what they're doing versus somebody who doesn't. Or maybe they do know what they're doing and they just don't care. Now, the last thing I'm going to say about this has already been a video a little bit longer than what I normally like to do. The last thing I'll say is this North American product is a really good product. So if this were a bad product, the discrepancy or the difference between designing it the right way versus the wrong way would be even larger. So the fact that this is a good product makes all of these bad designs still look relatively appealing. If you're working with somebody who's designing policies the wrong way and they're using a bad product, an example would be like the Transamerica Financial Freedom product. It's my least favorite product. If they're using that type of product and they're doing it the wrong way, then you've got a policy that's just designed to fail from the beginning. So anyway, I hope that this was helpful. Again, if you have any questions, any concerns, if you want me to do a policy review, which everyone should do a policy review at least once to make sure that they have something that's going to perform the way that they want it to perform, you can reach me at matt@leveragedwm.com, or you can go to my website, leveragedwm.com/contact-us. Fill out the form and we will be in touch. If you haven't done so already, please like this video. Please subscribe to this channel. It's my goal to bring you up-to-date, current, unbiased content in the realm of financial planning, specifically with life insurance, because it's so misunderstood and education is so sorely needed. I love these products as long as they're done the right way. If they're done the right way, it can be the best thing you ever purchase. If they're done the wrong way with a bad agent, it can be the worst thing you ever purchase. So please reach out to me. Let me help you. Thanks for watching this video. This has been Matt with Leverage Wealth Management. Take care.